Audit and assurance. Previous lecture, we have discussed about different types of audit report. Oh yeah, give me a minute, please. We have covered different types of audit reports. Under what circumstances auditor express what kind of opinion? Why we need to include in cases of matter paragraph? Why we need to include other matter paragraph? We have discussed about the key audit matter. We have discussed about other information. And we have discussed about going concern. I mean, what could be the reporting effect if company going concern position is affected? So let's discuss some more auditing standards, and then we will move towards key practice questions. We will cover 3, 4 good questions in each. Written representation. Written representation. During audit, what we need to do, we need to obtain sufficient appropriate audit evidence regarding each account balance in the financial statement. If we are having sufficient appropriate audit evidence, we will be able to express opinion. I mean, we'll be able to say if financial statements give to unfair view or do not give to unfair view. But if we don't have sufficient appropriate audit evidence, so there is a scope limitation. In that case, we will see whether the evidence not obtained are material nature. We will issue qualified report. If the evidence not obtained are of pervasive nature, we will issue disclaimer report. There are some account balances in the financial statements for which sometime we unable to obtain sufficient appropriate audit evidence. Sufficient mean quantity, mean enough evidence. So there could be some account balances in the financial statements against which we unable to obtain sufficient evidence. So to make the evidence sufficient, what we do, we require evidence from the company management. Please write on this page, like the amount of this account balance is what you have stated in the financial statement. That written page we are requiring from company management as an extra evidence is called written representation from management. So there are some account balances against which we sometimes unable to obtain sufficient evidence. To make audit evidence sufficient, we require written representation from management. What is written representation? This is an extra evidence. But on its own, written representation is not sufficient evidence. We should always obtain corroborative evidence. We should always obtain corroborative evidence. What is meant by corroborative evidence? Corroborative evidence means extra supporting evidence. What is extra supporting evidence? That we have obtained by performing our audit procedures. Obviously, we can obtain evidence by performing procedures. Evidence we have obtained through performing audit procedure is called corroborative evidence. And when this corroborative evidence is not sufficient, we asking the management to provide written representation mean an extra evidence. Because on its own written representation is not sufficient. Why it's not sufficient? Because management have stated a figure in the financial statement, so they will write on a page as well. But we should not rely on written representation only. We should obtain evidence through our audit procedures as well. Obviously, if our audit procedure evidence are not sufficient, we have asked the management to provide written presentation. If we are having on evidence mean corroborative evidence, management have provided written presentation. This means we are having sufficient evidence. Now we can express any kind of opinion. If we are having corroborative evidence that are not sufficient, and we ask the management to provide written presentation, but they refuse to provide written presentation, but we will say either qualified or disclaimer report due to scope limitation. Because these evidence are not sufficient. When these are not sufficient, what we are doing, we are asking the management to provide written presentation. If management refuse to provide written presentation, this means we do not have sufficient evidence. In that case, due to scope limitation, we will issue either qualified report or disclaimer. Can you understand this? If management have provided written presentation, but we don't have corroborative evidence, so on its own, written presentation is not sufficient. So again, there is a scope limitation. We will issue qualified or disclaimer report due to scope limitation. Can you understand this? If management refuse to provide representation, we don't have sufficient evidence. There is scope limitation. If management have provided written representation, but we don't have corroborative evidence, there is scope limitation. If we are having on evidence mean corroborative and management have provided written presentation, we will compare both. If both are same, this means we are having sufficient evidence. Now we can express any kind of opinion either in favor or against based on the evidence. But if our corroborative evidence and written presentation are not consistent with each other, mean our evidence showing something different while written presentation is showing something different, who is accurate, we cannot decide, because these on its own are not sufficient that we can decide, these on its own are not sufficient that we can decide. If both are contradicting with each other, even in that case there is a scope limitation. If we are having corroborative evidence, management refuse to provide written presentation, scope limitation. If there is only written presentation but no corroborative evidence, scope limitation. If both we are having and both are not consistent with each other, scope limitation. And due to scope limitation, we will see if the matter is material, we will issue qualified report. If the matter is pervasive, we will issue disclaimer report. If we are having both and both are same, then we have sufficient appropriate audit evidence, and we now can express opinion either in favor of the company or against company. Is that fine? So, do we require written presentation for every account balance? No. We require written presentation for two type of issues. One, we require written presentation for matters of facts known only to management. In matters known only to management. Matters known only to management. And we require written presentation regarding matters involving the judgment or estimate in their measurement. Involving judgment in their measurement. We require written presentation for two types of issues relating to financial statements. We require written presentation regarding matters known only to management. Mean there are some matters relating to financial statements that only company management is aware about. We being an auditor might not be aware about. Like if company have made any non-compliance with the law regulation and they haven't disclosed the fact anywhere, they keep it secret. This means this is a matter known only to management. So at end of every year audit, we will require a compulsory return presentation from management. Please sign and write this page that all non-compliance with law regulation have been disclosed to the auditor and disclosed in the financial statement. Because this is a matter known only to management. We being auditor, obviously, we are not checking things in more detail, in 100% detail. So might be we skip this kind of information. So at end of every year audit, this is a compulsory return presentation that we should require from company management. Please write on this page that all non-compliance with law regulation have been disclosed to the auditor and have been disclosed in the financial statement. This is called matters known only to management. If there is any fraud happen in the financial statement and management kept it secret due to maintain its repute, so at every year audit, we require a compulsory written presentation from management. Please write and sign this page that all frauds has been corrected to the financial statements and disclosed to the auditor. There are some matters that are known only to management against which we require written representation. We require written representation regarding any matters or account balances involving judgment estimate in their measurement. There are some account balance in the financial statements, which calculation is based on management judgment and estimate. What could be the account balances? Depreciation. In what should be the depreciation rate? It is based on company management estimate judgment. Provision, especially warranty provision. And if company has provided warranty to the customer, they need to create warranty provision. By how much amount? It depends upon company management estimate judgment. They will guess, okay, this amount of warranty claim we could receive in future. So they will create the warranty provision. So these are the figures based on judgment estimate. So we will require written presentation regarding these matters from company management. It also be trade secret. We're going to discuss first one in more detail now. So we require written presentation, not about all type of account balances. We require written presentation regarding matters involving judgment estimate in their measurement, like depreciation provisions, and we require written presentation regarding matters known only to management. And for these matters, we require compulsory representation at the end of every year audit. What could be the matters known only to management? We're gonna discuss in detail their list. And we require representation regarding some matters where management estimate judgment is involved in measurement in calculation. If we have obtained sufficient evidence about these matters, there is no reason to obtain representation. But if we don't have sufficient evidence, then we will require written representation from management regarding matters involving judgment estimate in their name. Can you understand this? What is the representation? Why we should require this? If management refuse, or there are no corroborative evidence, or it contradicting, we have discussed the audit report effect. Now, we're going to discuss in more detail what are the matters known only to management for which at the end of every year audit, we must require written representation. So this is the list. About management over our responsibilities at end of every year audit. We need to require written representation regarding management responsibility. What are the management responsibility? To prepare financial statements according to accounting standards, to provide access to records for audit purpose to the auditor and all information to the auditor for audit purpose, and all transaction have been recorded in the financial statements. These are matters known only to management at the end of every year audit. We will ask the management, please write on a page, these are your responsibilities, and sign it and provide to us as a evidence like you have performed your responsibilities. What kind of responsibilities? Preparation of financial statements as per accounting standards, You have provided all the information to the auditor relating to audit purpose and access to records for audit purpose, and all transactions have been recorded into the financial statement. At the end of every audit, we will require a written presentation from management regarding the assumptions and estimates. Please sign on this page. All the significant estimates or assumptions relating to financial statements are reasonable. At the end of every year audit, we require a written presentation regarding related party transactions. What are related parties? Directors, their spouses, subsidiaries, joint ventures, parent company. If company is having transaction with related parties, company need to disclose in the financial statement. So we'll require a written representation from management. Please write and sign this page. All related party transactions and relationship have been disclosed to the auditor and have been disclosed in the financial statement. Because these are matter known only to management. At the end of every audit, we will require a compulsory written presentation regarding subsequent events. Subsequent event mean events after the reporting period. We will ask the management to write and sign this page that all adjusting events have been adjusted to the financial statements and non-adjusting events has been disclosed in the financial statement. And we will require a written presentation from management regarding immaterial misstatement. Please write and sign this page that all uncorrected misstatements are immaterial. If there is any misstatement in the financial statements that has not been corrected, that is not material, mean immaterial. Immaterial mean not material. And we will require written presentation regarding fraud, that all frauds happen has been disclosed to the auditor and disclosed in the financial statement, mean disclosed and corrected in the financial statement. And we will require written presentation regarding non-compliance with law regulations, that all non-compliance with law regulations has been disclosed to the auditor and disclosed in the financial statement. And one relating to litigations, that all litigations claim have been disclosed to the auditor and accounted for in the financial statements as per accounting standards. So we require some compulsory written presentation from management at end of every year audit, because these are the matter known only to management. What are those? Regarding management responsibility, assumptions and even estimates, related party transactions, subsequent event mean adjusting non-adjusting events, immaterial uncorrected misstatements, frauds, non-compliance with law regulations, and litigations. So these are matter known only to management, and for these, at the end of every year audit, we need compulsory written presentation from company management. Can you understand this? This standard is completed now. Who is providing written representation to whom? Company management providing written representation to whom? To auditor. But interestingly, its wording is designed by the auditor. Auditor will write the wording on a page and ask the management to sign it. Though provided by management to auditor, but who will design the wording? Management. So management can refuse to sign it. If they have refused, what we need to do? Might be they do not agree with the wording. So we can ask them to provide through alternative wording. If they are not providing through alternative wording, even alternative wording, mean after change of wording might be they agree. But if in case of change of wording, they do not signing it, we need to discuss with management regarding importance of this written presentation, because without this, we will not be having sufficient evidence. We will not be able to express opinion. Obviously, we will qualify the report. and they have agreed in letter of engagement, like during audit, if we require written representation, they will provide us. So we'll try to agree with them through reference of letter of engagement and by explaining the importance of this representation from audit evidence point of view. But despite discussion, despite change of wording, they are still not providing this, in signing this. In that case, we will be having two options. Either we can qualify audit report due to scope limitation, or if management is not providing this means there is some issue. Might be there are some issues relating to other account balances against which we have already obtained evidence. This means there is a suspicion on company management integrity. And if their integrity is doubtful, we should resign from the audit, because we should not associate our audit report with this kind of wrong people. If they do not provide, we should agree management with the alternative wording. If through alternative wording they do not agree, we should discuss the importance of this written representation from audit report point of view. They still not signing, then either we can qualify audit report due to scope limitation, or we can resign from the audit. So this standard is completed now. Now we are moving towards discussing one more important auditing standards, that is called subsequent event. Subsequent event. Before discussing subsequent events, let's discuss an accounting standard IAS 10. In financial accounting, we have studied the standard IAS 10, events after the reporting period. To be an auditor, you must be an accountant. And without accounting knowledge, you cannot become auditor. So we must be aware about accounting standards as well. Then we can identify whether there is misstatement or not. So let's discuss accounting standard IAS 10. IAS 10 says, who prepare financial statements? Company management. So they need to look for different events that occurred between year and date and date. Directors approve financial statements for issue. Auditors. Company year end is supposed 31st December 2023, but company issue financial statements or prepare financial statements after year end, because they need to issue financial statements at AGM. And normally company conduct AGM normally after 3 to 4 months of the year end. And before issuing to the public, director approve means sign the financial statements. Sign approval means we have prepared, we are responsible for this. So what a company management need to do while preparing financial statements, they need to see some events occurring between year end date and the date director approve financial statements for issue. And from those events, they need to identify adjusting events. And they need to identify non-adjusting events. Where they need to identify adjusting, non-adjusting events, year and date, till the date director approve financial statements for issue. After this date, the events occurring will be neither adjusting nor non-adjusting. They will be relating to next year financial statements. So from year end date till date director approve financial statements for issue, they need to identify adjusting and non-adjusting events. Adjusting events should be adjusted in the financial statement. Mean there should be any accounting entry for these events. Mean any account balance should be added or subtracted relating to these events. Where? In the financial statement. While non-adjusting events need to be disclosed in the financial statements, mean there shouldn't be any accounting entry. No account balance should be added or subtracted. They should be disclosed only. What could be the adjusting events? There is a receivable in the financial statements written at that date. Here we are aware that receivables become bankrupt, become insolvent or lost somewhere, mean company will not be able to recover money from this receivable. So whether this receivable written in the financial statements is a receivable? No. This means you need to create bad debts premium for these receivables as it is adjusting event. There is any inventory recorded here at the year end at cost, because for IAS 2 inventory should be recorded lower of cost and NRV. And for normal inventory, cost is always lower than NRV because NRV include profit element as well. So they have recorded an inventory here at cost. But after year end, when that inventory is going to sell, we saw that, or we have seen that inventory is going to be sell at a very minimal amount, lower than its cost. This means NRV is lower than cost. So inventory should be adjusted here because it is adjusted. There is any asset recorded here, like property recorded here for 10 million. But here we are aware that that property market value is 7 million. In fact, property value is 7 million rather than 10 million. This means company need to impair its property and restate its inventory at 7 million in the financial statements because this is the adjusting event. So adjusting events are those events against which condition exists at the year end date. I mean, there is any account balance in the financial statements that need to be adjusted. What are the non-adjusting events? Here, company destroyed its fixed assets due to fire or flood. Where fire or flood happen, where company have suffered the loss after year end. This is loss relating to next year financial statement. But as we are aware about it before issuing this current year financial statements, so we need to disclose in the financial statements so that shareholders should be aware about it, that in coming year financial statement, this loss will be created. After year end, company have acquired any subsidiaries or company have disposed of any subsidiary. So this will be having an effect in coming year financial statements, consolidated financial statements. But as this event has happened before this year financial statements issue been approved, so we need to disclose this as non-adjusting event. Is that fine? So this is accounting standard IAS 10. Who should follow accounting standard? Company management, not auditor. Auditor should check whether company is accounting as per accounting standard or not. Now we're going to discuss about an auditing standard called ISA 560 subsequent view. So company management responsibility to find adjusting, non-adjusting events between year end date and the date director approved financial statements for issue. And there is only one period that has been defined where they need to identify adjusting, non-adjusting events. After this, they don't need to identify adjusting, non-adjusting events. Only in this period, they need to find adjusting, non-adjusting events. From audit point of view, being auditor, we are having some responsibilities regarding post year end events as well. What are our responsibilities? Our responsibilities are something different like balance sheet date. What is meant by balance sheet date? Year end date. So from balance sheet date till audit report sign, we have some responsibilities. Even we are having some responsibilities after signing the audit report, but before issue of annual reports. What is annual reports? Combination of audit report and financial statements. Even we are having some responsibilities after issue of annual reports, mean audit report as well. And this period from year end to audit report sign date is called period one. We will call it period one, not standard have defined. We are calling it period one. And from audit report sign date till audit report issue date, we will call it period two. Period three is after issue of audit report. Annual report means audit report. This period one is the same like IAS 10 period, because one day director approve financial statements for issue. On that date or very next day, we sign the audit report, because they need to issue financial statements along with audit report in the annual report at AGM. So this is same period as per IAS 8. And this is also called our final audit period, because we need to perform some work after year end, that is called final audit. Whether auditor is active in this period or passive. In period one, whether auditor is active or passive. Active mean he is performing active review, active audit procedures. What auditor is doing in that period? Performing audit procedures. Through cash receipts, he is verifying receivables. Through cash payments, he is verifying payables. What else he is doing? Through sale proceed, he is verifying cost and RV of asset. For receivable, he is performing confirmation. For liabilities, he is performing confirmation from the lenders. And through dispatch note, GRN, he is performing cut-off testing as well. In auditor is active, he is performing some active procedures. If auditor is aware about any misstatement in the financial statements during this period, what he should do? If auditor have identified any misstatement, what he should do? He should request the management to correct the financial statement. And if management do not correct the financial statements, what he should do? He should qualify the audit. Is a fine. If auditor asks, if examiner asks, what auditor do between the date of year end and audit report sign date? Can we write something? What auditor do? What are the procedures auditor perform between year end date and the date audit report sign? He is performing active audit procedures. He is inspecting cash receipt to verify receivables. He is inspecting cash payments to verify payables. He is inspecting sale invoices to verify cost and RV of inventory. He is performing cut-off testing through GRN, GDNs. He is performing debtor confirmation. He is performing liabilities confirmation. He is obtaining written representation from management. He is ensuring adjustment of adjusting events and disclosure of non-adjusting events. Is that now? And if auditor find any misstatement during period one, what he should do? He should ask the management to correct in the financial statement. And if management do not correct the financial statements, he should qualify the audit report. Either adverse or qualified based on materiality pervasiveness. Now we're gonna discuss about period two. Audit report has been signed. Audit work has been completed, but not issued yet. because management waiting for the AGM. At AGM, they will issue. Who is holding the audit report? Company management. We have assigned and given to company management. Please print, attach with your annual reports, and then issue at AGM. Whether auditor is active or passive. If audit report has been signed, audit report completed, auditor active or passive? Passive.
Passive.
He don't need to perform any audit procedure because audit has been completed. But he should be alert regarding any information relating to the reported financial statement. If in period 2 auditor are aware about any misstatement in the financial statements that we have checked, in that misstatement was not identified here. Here we have identified the misstatement. This means the financial statements going to be issued are incorrect. Our audit report could also be incorrect. And if company have issued wrong financial statements along with our wrong audit report and public aware of this, public will be filing sue against auditor for damages. So what we need to do? We need to ask the management to amend the financial statement. We are aware there is a misstatement in the financial statements that we couldn't identify here, but now we are aware of it. Now, please, you need to amend the financial statements. Do not issue these wrong financial statements. And if management amending the financial statements, we will sign a new audit report, because audit reports should be signed after the approval of financial statements. And if they are amending the financial statements, this means they are preparing new financial statements and then they will sign. So our audit report should also be newly signed after the financial statement date. And if management do not amend the financial statement, what we will do? We will speak the matter at AGM to shareholder and we will withdraw from our audit report. Like we asked the management to correct these financial statements, they didn't correct it. So financial statements are not reliable and we are withdrawing from our audit report because this report is not reliable. If in period 1 auditor finds the misstatement, he should request the management to correct in the financial statements. If management do not correct, we can qualify audit report because audit report is not still signed. But in period 2, if auditor is aware about any misstatement in the financial statements that are going to be issued, we should request the management to amend the financial statements, mean correct the financial statements. If they do not amend correct, we will speak the matter to the shareholder at AGM and withdraw from our audit report. If management have amended the financial statements as per our request, then we will sign a new audit report after approval of amended financial statements. Is it fine? Though audit work has been completed, there is no responsibility to perform any procedure, but we should remain alert regarding any information. And if there is any information regarding misstatement in the reported financial statements, we should ask the management to amend it. Prepare new financial statements after correcting the statement, and we should sign new audit report. So that correct financial statements, correct audit report should be issued here. And if management do not amend, we cannot sign new report alone because our audit report is always on financial statement. And if they do not amend, we will speak the matter at the AGM to shareholder and we will withdraw from our audit report. Okay, now moving towards period 3, financial statements audit report has been issued. Period 3, financial statements audit report has been issued. They are in the hand of public. Public means stakeholders are making a decision based on the financial statements audit report. Is auditor active or passive? Passive. Is not active. Mean we don't need to perform any procedures. But we should be alert regarding any information as well. If in period 3 we are aware that there was any misstatement in the financial statements, this means the financial statements that public is using are incorrect. Might be our audit report is also incorrect. And we are aware about this information. If public become aware, they will sue us for damages. And what could be those damages? Nobody knows. So to save ourselves from those damages, what we need to do, we need to take some immediate step on emergency basis. What step we will take? We will ask the company management to issue new financial statements after corrected this misstatement, and those new financial statements will be called revised financial statement. Mean we will request the management to issue revised financial statement, because if one version have been published, now you're gonna publish its corrected version. So corrected version will always be called revised version. So we'll ask the management to issue revised financial statements. And in revised financial statements, management have to disclose, provide a disclosure why financial statements have been revised, what was the misstatement in previous financial statement. And if management agree to issue revised financial statements with the disclosure, what we will do being auditor, we will also issue revised audit report. And in revised audit report, we will highlight this disclosure of financial statements. How we can highlight any disclosure in financial statements in audit report? By including emphasis of matter paragraph. And why we are revising our audit report? Due to that disclosure in revised financial statement. And if management do not revise the financial statement, we cannot issue the revised audit report alone, because our audit report is always on financial statement. If management do not revise the financial statements, what we need to do? We need to consider speaking of the matter to shareholder. If we are the auditor in next year, we can resign and call EGM of shareholder and inform them. If we are not the auditor for next year, we can speak this matter, inform shareholder through press release. Or we will seek legal advice. We will consult lawyers. What we should do in this case? Because if there will be any claims against us in future, how we can save ourselves? Either we should issue press release or we should wait for the claims. Because we have discussed with management to issue revised financial statements, but they do not agree with us. So if auditor have identified any misstatement in period 1, year end date to audit report assigned date, he should request the management to correct in the financial statements. If they do not correct, we can qualify our report because our report is not assigned yet. If auditor have identified any misstatement in period 2, we should ask the management to amend the financial statements, and we will sign a new audit report after amended financial statements. If management do not amend, we will speak the matter to shareholder at AGM and withdraw from our audit report, because auditor has a right to attend AGM as well as speak. If we have identified any misstatement in period 3 relating to this year and financial statement, we will ask the management to issue revised financial statements with a disclosure explaining the reason for the revision. And we will issue revised audit report with emphasis of matter paragraph to highlight that disclosure of revision. But if management do not revise the financial statements, we will consider speaking of matter to shareholder and we will take legal advice. Is it fine? Is that fine? Okay, now we're gonna discuss something technical. If in period 3 we are aware about the misstatement and we became aware too late, that much late, like there is no time for preparing revised financial statements because the next year financial statements is going to be issued, is going to be prepared. In that case, we will request the management do not revise the financial statement. What you need to do, you need to adjust this misstatement in coming year financial statements as prior year adjustment. Because there is no time for issuing revised financial statements. The time we issue revised financial statements, the next year financial statements will be issued in that time. So last amendment, there is no time for issuing revised financial statements. Adjust this misstatement in coming year financial statement. Mean coming year financial statements comparative figures, mean prior period figures will be adjusted, and you need to provide a disclosure in the coming year financial statements like this amount we corrected from previous year because there was a misstatement in previous year financial statement that was not identified yet. But if this prior year adjustment will happen in the coming year financial statement, shareholder become angry. Why you didn't inform us before about this? Now we have made this. So we'll ask the management to issue profit warning as well. Profit warning means informing the shareholder about this prior year adjustment in coming year financial statement. So that they should be aware about it that in coming year financial statements, there will be some adjustment relating to previous year misstatement. Because if you are not informing the shareholder, and suddenly when they saw the financials, they will see the financial statements, they become angry. And you will not be able to tolerate that. There will be big issues. So please prepare their mind before this prior adjustment, mean inform them either by conducting meeting, either by letters, either by emails, either by press issue. Mean issue profit warning. Issue profit warning mean informing the shareholder regarding this prior adjustment in the coming year financial statement. So from accounting point of view, there is only one period after the year end. That is from year end date to date director approve financial statements for issue, and this is for company management. While preparing financial statements, they need to identify adjusting, non-adjusting events. Adjusting event they should adjust, non-adjusting event they should disclose. From audit point of view, we are having three different period responsibilities after year end. First period is between year end date and date audit report is assigned. Second period is after signing the audit report, but before issuing to the general public. We being auditor also having responsibility even after issue of the audit report as well. In period one, if we have identified any misstatement, we will ask the management to correct in the financial statement. If they do not correct, we can qualify the audit report because audit report is still not signed. And this is our active audit procedures period where we perform procedures where we need to check different things. This is our final audit period. period 2 audit work has been completed, auditor have no responsibility to perform procedures, but he should remain alert regarding any information relating to financial statement. And if he is aware about any misstatement in the reported financial statement. So before company issue wrong financial statements, he should take some steps. What he need to do? We need to ask the management, request the management to amend the financial statement, mean correct the financial statement so that corrected financial statement should be issued, not revised because financial statements has not been issued yet. And we will sign new audit report, not revised report. Our audit report name will be audit report. If management do not amend, we will consider speaking of matter to shareholder at AGM and will withdraw from our audit report. In period 3, audit report financial statements has been issued. But if auditor is aware about a misstatement in the financial statements against which we have provided the audit report, this means only we are aware about it. If public will become aware about it, they will they will sue us for damages. So to save ourselves from damages, from bad repute, we need to take immediate emergent steps. We should ask the management to issue revised financial statements after correcting the misstatement. And in revised financial statements, we will ask the management to provide our disclosure, mean explain the reason why we are issuing revised financial statements. And we will issue revised audit report with emphasis of matter paragraph to highlight that disclosure, explaining the reason for the review. And if management do not revise the financial statements, mean not agreeing with us, we need to take legal advice and consider speaking of matter to shareholder regarding whatsoever sources, either through press issue. If we are the auditor for next year, we can resign and call EGM. But if in period 3, we becoming aware about the misstatements too late, there is no time to issue revised financial statements because coming year financial statements are nearby. In that case, we will ask the management, there is no time for revised financial statements. So please adjust this misstatement in coming year financial statements as a prior year adjustment. Mean opening balances will be corrected and there should be a disclosure in the coming year financial statements regarding prior adjustment. But due to this prior adjustments, you will not be able to handle the shareholders' concern. They will argue. So please issue profit warning. Profit warning means inform the shareholder regarding this prior adjustment going to be happen in coming year financial statement so that they should be prepared about it. If you are not informing about this before issuing of next year financial statements with prior adjustment, they will argue. They will fight. Is that fine? Any question online? Any question from online students?
Yeah, yes, sir.
Yes, please.
Yeah,
Question regarding period 1, period 2, period 3.
no, sir. These mistake only auditors are the responsible for this mistake or management, sir.
Management also responsible, but obviously if auditor haven't identified,
Okay.
there will be responsibility on the auditor as well.
Okay.
Because due to this misstatement might be we have a stated financial statements give true and fair view. But in fact, they are not true and fair view. This means stakeholder can sue us for damages as well.
Second, that amendment of the financial statement. That time again, they will contact AGM
Before AGM,
before.
because AGM will be here. AGM will be here where company will issue annual reports, audit report.
Okay.
So if management do not amend, then we will speak this matter at the AGM to the shareholder and we will withdraw from our audit report. Is it fine?
Yeah, yes, sir.
So these are the 3 periods: balance sheet date to audit report sign date period 1, and audit report signed to financial statements issue date period 2, and after issue period 3. And these are the auditor responsibility from period 1, between period 2, period 3, that you can read by yourself. How many letters auditor signed during the audit? I mean, what are the written communication of auditor during the audit? Professional clearance letter. Before accepting the audit, we need to ask the previous auditor any reason behind leaving the audit. How we can ask previous auditor, contact previous auditor through professional clearance auditor. With predecessor auditor, mean the auditor that was before us. There is no particular form. Yeah. Engagement letter is auditor formal appointment letter where he agree management responsibility and auditor responsibility. Confirmation letter, that is from third party like debtor confirmation, bank confirmation. Representation letter from company management to obtain extra evidence. Audit report, that is for shareholder. And letter of weaknesses, if we are finding any issues during the audit, we should communicate first to company management. Not only we will highlight the weaknesses, we will provide recommendation controls how management can correct it. That is also called management letter because we are sending this letter to company management. Is it fine? Okay. So let's discuss 1, 2 more standards and then we will move towards questions. ISA 510 initial engagement. Initial engagement, or you can say opening balances. What is meant by opening balances? Balances coming from previous year. In previous year, closing balances will become opening balances of current year. We can verify opening balances by comparing them to previous year financial statement. If they are same as compared to previous year ending balances, this means they are accurate. If we are the auditor in previous year as well, there is only one procedure to verify opening balances, mean compare them to previous year financial statement. But if we were not the auditor in previous year, then we need to perform some procedures as per ISA 510. Even if we were the auditor in previous year, even we don't need to compare with previous year financial statements because we know they are accurate. But if we were the not auditor in previous year, then we need to verify opening balances. How? By comparing with prior financial statements. We need to make sure the brought forward balances are the same with no error as compared to previous financial statements. I mean, there are no errors in brought forward balances. We need to make sure company consistently applying accounting policies. In the policies in previous year are same in current year, like depreciation rate previous year, current year should be same. And we have to make sure that previous year's financial statements figures were accurate. Mean we need to perform some procedures on the opening balances. We need to review previous year working paper as well. Obviously, working paper will not be there. In that case, we need to perform some procedures on opening balances as well. In previous year financial statements estimate judgment, we need to perform some procedures. If auditor unable to verify opening balances, if auditor unable to verify opening balances, what we can do? we will issue either qualified report or disclaimer report due to scope limitation. Because opening balances also having effect in current year closing balances. And we are unable to verify opening balances, this means there is scope limitation. If previous year audit report was qualified, why? Because closing balance was inaccurate, misstated. And the matter has been satisfactorily resolved. Now that matter has been resolved, management have corrected the misstatement. Whether this will be having any impact on current year audit report? No. If previous year financial statements was qualified due to misstatement in previous year financial statements, and that matter has been resolved now, so there will be no effect on current year audit report because matter has been resolved. This means opening balances in current year are accurate. But if previous year financial statements was qualified and matter still unresolved, mean previous closing was misstated. This means current opening is also misstated. This means we need to qualify current year audit report as well due to misstatement in opening balance, and that will be except for rather than will be adverse. In that case, qualification will be necessary on the ground of misstatement. If previous year audit report was qualified due to misstatement in the financial statement, and that matter has been resolved, there is no effect on current year's audit report. No effect on current year's report. But if not resolve the matter, we should qualify the current year audit report on ground of misstatement. But if we are unable to verify opening balances, in that case, we should qualify current year audit report on the basis of inability to obtain sufficient appropriate audit evidence, means scope limitation. When we need to perform this ISA 510, when we were not the auditor in previous year, you know, and if we were not the auditor in previous year, there was any other auditor, we should always highlight by including other matter paragraph in the audit report as well. And if prior year financial statements were not audited or audited by any other firm, we should highlight this fact by including the matter paragraph in the audit report. It's not other information, it's other matter. Is it fine? Yeah?
Large government spend annuity in the second one. You qualify for restaurant.
If matter is not resolved, we will see whether that figure misstatement is creating a material effect on current year, qualified. Immaterial effect, unqualified. No scope limitation. This will be relating to misstatement.
Okay.
Now discuss another accounting auditing standard ISA 710 comparative information. Comparative. What is meant by comparative? IAS 1 says company need to prepare comparative financial statements. Comparative mean along with current year figure, they need to show previous year figures as well. Company need to prepare comparative financial statements. While preparing financial statements for each account balance, they need to show current year figures as well as previous year figures. If company is not preparing comparative financial statements are accurate or wrong? If companies are not preparing comparative financial statements, whether financial statements are accurate or wrong? Wrong, not prepared as per accounting standard.
Even if all the values are correct.
If they do not provide these previous year figure, so there is a non-compliance with IAS 1. If there is non-compliance with the accounting standard, financial statements are wrong, we will qualify the audit report, except for comparative financial statements give and fair. Is it fine? Now discuss these reporting effect. If there were material misstatement in the preceding year, financial statements, but no audit report qualification was issued because we couldn't identify it during period 1. And financial statements were revised because auditor became aware about the misstatement in period 3, and as per auditor request, management issued the revised financial statement. I mean, if prior financial statements has been revised, this means this comparative should be as per revised or as per those previous wrong financial statements. Should be as per revised. If they are as per revised, unqualified opinion. But if financial statements were revised, but these comparative has not been revised, this means qualified audit report. So if there was misstatement in previous financial statements, but no qualification was issued, financial statements were revised, the auditor must check a comparative this year, and if properly stated as per revised, unqualified, unmodified report can be given. Where no revision of the previous financial statements was made, but this year comparative have been adjusted because we asked the management to adjust at prior year adjustment. Even no qualification of opinion this year is necessary, but we need to include emphasis of matter paragraph to highlight the disclosure of prior year adjustment. If there was misstatement in previous year financial statement that we identified during period 3, if management issue the revised financial statements and comparative as per revised, unqualified opinion. If comparative are not as per revised, qualified opinion. But if we request the management to adjust this as a prior adjustment in the coming financial statement, so for the coming year financial statements, audit report should be unqualified, mean no qualification. But regarding this prior adjustment disclosure, we need to include emphasis of matter paragraph. Where there was no revision and comparative are not restated, mean neither management issue the revised financial statements, neither they adjust prior adjustment. In that case, we will qualify current year's audit report because comparatives or opening balances are incorrect. And if auditor didn't audit the previous financial statements or audited by any other firm, we should highlight through other matter paragraph. Can you understand this? Let's take a break. Now we should discuss a question. We can discuss a question. Chestnut. Question 173 to 177. The following scenario related to question 173 to 177. It is 1st July 20x5. Assume today is 1st July 20x5. You are the audit manager of Chestnut and Company and are reviewing the key issues identified in the files of two audit clients. And you are checking audit files, mean working paper of two audit clients. Two audit clients. The first audit client is a Palm Industry Company, Palm, a listed company. Palm's year end was 31st March 20x5. And the draft financial statements show revenue of $28.2 million, receivable of $5.6 million, and profit before tax of $4.8 million. And when examiner are stating the company profit, revenue, total assets in the question, this means in this question you need to calculate materiality figure. There will be some part relating to this. There will be some marks relating to this. Because based on materiality, you will decide whether you should issue qualified report. If the matter is immaterial, unqualified. So whenever there are sales, profit, total assets figure given in the question, this means there are some marks relating to materiality calculation. So they have provided this is the revenue 28.2 million, receivable 5.6 million total, and profit before tax 4.8 million, and the field work stage of this audit has been completed. The customer of Palm earned an amount of 350,000 at the year end. Whether this 350,000 is material or immaterial, can you check? Against revenue 28.2 million. 28.2 million mean 282000000, because the receivable figure is 350,000 given in complete. So you need to write down complete 28.2 million. 28.2 million mean 282000000. How much is that of sale? 350,000 divided by
1.2, 1.2.
1.2%. If 1% or more of revenue become material, can you check its materiality against a profit of 4.8 million? Is that 5% or more of profit?
So,
7 point something percent and material. Can you check this against total receivable of 5.6 million?
6.3%.
Is that 10% or more? Might not be about 10%, but it is material against sales and profit. Okay. So customer of Palm owed an amount of 350 at the year end. Testing of receivables in April highlighted that no amount had been paid to Palm from this customer, as they were disputing the quality of certain goods received from the Palm. In company have written a receivable, but no amount has been received, and there is a dispute between company and customer. Customer say, I will not pay. Why? Because company have provided some wrong quality goods. The finance director is confident the issue will be resolved, and no allowance for receivable was made with regard to this balance, and they didn't adjust the receivable against this amount. But there are concerns. Mean these could be bad debts. There is issue. The second audit client is Ash Trading Company, Ash. So regarding Palm, there is a issue of bad debts, and that amount is material. The second company is Ash. Ash is a new client of Chestnut Company. Its year end was 31st January 20x5. And the firm was only appointed as auditor in February 20x5. That's the issue here. We couldn't verify the inventory. We couldn't verify the cash in hand. There is a scope limitation. There is scope limitation. As the previous auditor was suddenly unavailable to undertake the audit, the field work stage for this audit is currently ongoing. Mean we are performing procedures. The inventory count at Ash's warehouse was undertaken on 31st January 20x5. Mean at year end they performed inventory count and was overseen by the company's internal audit department. If internal auditor is good person, qualified, his objectivity, independence, no issue, we can rely on it. Neither Chestnut and Company mean audit firm nor the previous auditor attended the count. Detailed inventory record were maintained, but it was not possible to undertake another full inventory count subsequent to the year end. and company do not agree to perform count again. There could be some staffing issues. The draft financial statements show a profit figure of 2.4 million, revenue of 10.1 million, and inventory figure is a 510, whether this inventory is material to the financial statements or not. Can you check this materiality? 510 against revenue and 510 against 2.4 million profit.
21.2.
Use your calculator, online students.
21.25%.
1.25 against profit, highly material.
Oh.
Even material against revenue as well. 0.5 million is above 5% of revenue as well. Material. Okay. Now moving towards questions. This means in a palm company, there is an issue of receivable material amount. And in a ash company, there is a issue of scope limitation relating to inventory and material amount. Question 173. A little bit tricky. Which of the following audit procedures should be performed in order to form a conclusion on whether an amendment is required in palm company, in whether bad debts are required or not, in respect of the disputed balance of receivable? Review whether any payment have subsequently been made by this customer since the audit fieldwork was completed. Yes, through this we will be able to verify whether bad debts required or not. Match the total of age receivable listing to the sales ledger control account. So through this, we cannot verify whether bad debts premium has been created or not. Through this, we can only verify there is no posting error with the ledger. So this is not relevant here. Vouch the balance owed by customer at the year end to sales invoice. If finance director is saying this is the balance, why we need to vouch whether the sale has happened or not? Basically, sale has happened. That's why finance director is saying this balance is we will recover. Customer is having argument with the company. So this is not appropriate in this situation because we are not verifying occurrence of sale or receivable. Vouch mean compare, mean inspection of documents. Voucher, vouch mean comparing voucher, mean documents. Review the latest customer correspondence with regard to an assessment of the likelihood of the customer making payment. Correspondence means communication with the company. Through this, we will able to identify how much chances that customer will pay. So this will also be a relevant procedure. Is it fine? A little bit technical. I mean, what could be the relevant procedures regarding a verification of bad debts? Question 174. Which of the following correctly summarizes the effect of the issue relating to the inventory count of ash at the year end? Is that inventory material or immaterial? Material. This means either C or D, no ARP, because we have calculated materiality. And based on calculation, we can say this is material, no or yes. Yes, it's material. Opening inventory may be materially misstated. Is that relating to opening inventory or closing inventory? Closing inventory. Inventory at year end count. We will verify closing inventory, not opening inventory. Gross profit may be overstated. Obviously, if inventory balance is different, then they have written in the financial statements. So GP could be different. There is no other option with the materiality. What is the best option? This. Is it fine? Because we have performed calculation and inventory figure is material. So first two options are not there because inventory is material. 175. The audit engagement partner for ASH has requested that additional audit procedures be performed in order to conclude on the level of adjustment needed in relation to the above inventory issue. He has identified there is issue in inventory figure and has requested the additional audit procedure should be performed. Which two of the following audit procedures should be performed in order to form a conclusion as to whether ASH financial statements require amendments? Obtain a copy of aged inventory report and use computer assisted audit techniques to verify the accuracy of the report. Discuss the valuation of slow moving inventory with the production director. Is there any issue of slow moving out of date inventory? There is no issue of slow moving out of date inventory. Issue is that we couldn't attend the inventory count. There is issue of inventory existence, whether that inventory exists at year end or not. This is relating to valuation. Number two, review the internal auditor reports of the inventory count to identify the level of adjustment made to the records in order to assess the reasonableness of relying on the inventory record for the purpose of the year end, because he was involved. Perform test count of inventory in the warehouse and compare these first to the inventory record in floor to sheet, and then form inventory record to warehouse sheet to floor in order to assess the reasonableness of the inventory records maintained by ASH. This could be existence and completeness. Number four, review ASH sale order book for February, March, and April. No, through this we can only identify sale rather than inventory. So what could be the relevant relating to inventory? 2 and 3. This is also a bit technical. 176. Following the inability to attend the inventory count of ASH, an engagement quality reviewer who is checking the quality of audit work through working paper has been appointed to the audit. Indicate which of the following should be included within the engagement quality control review. I mean, what things he will check relating to audit quality to quality control reviewer. Evaluation of all significant audit judgment. He will evaluate all significant audit judgment relating to inventory. Evaluation of the performance of specific audit procedures performed. Evaluation of the cost effectiveness of the audit process. This is not relevant. He will not check cost effectiveness of the audit procedure performed. He is checking quality of the audit procedure. Evaluation of conclusion reached in formulating audit report. What he will include, what he will not include. So one we have identified will not be included. Evaluation of performance for specific audit procedures performed. Yes, he need to check what procedures auditor have performed, whether he has performed as per auditing standard or not. Evaluation of conclusion reached in formulating audit report. Yes, whether auditor have checked materiality proper or not. And what is our first? Evaluation of all significant audit judgment. Yes, there is a audit judgment involved due to scope limitations. So this he will include, this he will include, this he will include, but the third one will not be included in quality control work. 177. alternate procedures performed as a result of Chestnut Company being unable to attend the inventory count of ash didn't provide sufficient appropriate audit evidence regarding the inventory balance in the statement of financial position. Through other procedures we have identified, like we don't have sufficient evidence relating to inventory because we couldn't attend the inventory count and we couldn't verify the inventory balance correctly. There is inability to obtain evidence. Being auditor is not having sufficient evidence regarding inventory counting. From the opinion below, indicate the audit opinion which would be given in these circumstances and the appropriate disclosure in the audit report. Opinion should be qualified based on basis of qualified opinion. Disclaimer, is that pervasive misstatement, a pervasive scope limitation? No, only inventory, and inventory is just material rather than pervasive. You know, so there is no option of disclaimer. Qualified key audit matter section. No, if we are qualifying the audit report where we will explain the reason behind qualification, basis for opinion. Disclaimer in faces of matter, no, there is no chance of disclaimer. So what's the correct option?
Question.
A on. You know. And in faces of matter never ever appeared with the qualified adverse or disclaimer. It's always appear with unqualified opinion. This is technically wrong. So what else remain? Disclaimer, there is no chance of disclaimer. And what is qualified key audit matter section? No, if we are qualifying the report, we will explain reason where in basis for opinion paragraph. Okay. So let's have a break. After break, we will discuss some more questions.
Section B. Should we, which one go like? I have 20 left, I think. How many have you done? 30? 25, 25. 25. How about you? The thing is, I started doing it very rigorously like last week. So I've probably reached about 7, 8. So only I know that's less, but I'm going to do a lot now. Once you do like the first step, it becomes faster. Yeah. I've only done probably like so the first topic doesn't have like a section B, right? First topic. Yeah, just section like control versus some stuff. No, not internal control. Internal control. No, I doing some BPP at top down. How many questions? It's just yeah, I'm just like from BPP because that's so one different things. Yeah. The BPP has 4 headings, right? Yeah. No, Kaplan has 4 headings. No, there's 3 for section B, 4 for the other. Okay, so the way I didn't open Kaplan really, I just used BPP. And that has 5 total, and each has section A and section B. So I did the first 3 topics. Okay. So yeah, 2 or 3 left. And here's now. For like it's just like it's done. How many do you do in a day? Is that and I do like 3 one each. Go for this. No. In one day I do 3 long for both PM and non. Do you practice fracturing questions? Yeah, I usually finish them when he finishes. So when he teaches us yeah, matrix internal controls, I'll finish all the internal control questions. It's only like 50 for each topic, like 50 questions for multiple choice. I'm doing like one day. Didn't audit in your other college? No. That college, it's like it's too simple. I already know what's happening. It's not this. They're teaching what we studied in management accounting. Oh, right. Yeah. It's not PM. How? I mean, it's not like PM. It's more. Yeah, it's more. I mean, if they're doing process costing, activity based costing. Ah. And like the one subject is financial accounting, but that's the very, very, very basics. Like how do you make a journal? How do you make a trial balance? I attend just to get the attendance, but I don't actually pay attention. I just study ACCA or something else during those lectures. Okay. So next session, you were taking somewhere else, right? Or just halting, just those more. Next session, I haven't decided. Yeah, it depends because I have college exams going on. That's the thing. So on the day of this exam. But did you take the exam for audit or not? This session for March 7? I did. For this one, by chance, I think I may or may not have an exam the same day of college, so I'm stressed about it. It's not a final exam, it's like a midterm exam. Okay. Like 20 or 30% of the grade, which is I hope it's the same day, March 7. Could be. It's the same week, and haven't told the day yet. So yeah. What time did you do for March 7? 1:30 to 1:30. Okay. Yeah. The same. Well, because there were two slots. So one was like early in the morning. Yeah, like 11, and then 1 p.m. I booked on the last day of standard rate. So there was only two slots, I think. For me, one was in the morning, earlier than 11, and the other one was at 1:30. Um, the the 1:30. I think it was the 1:30. Did you get that attendance docket thing? Maybe he sent on the mail, like it's basically the card that you need to bring along with the exam. So for these ones, I never do, but to me, this is the only thing I'm good at. Yeah, that's the reason I did well in my first three tests. Yeah, I guess it's mostly like this. Yeah. I'm only worried about long form because long form, I get scared that I won't include all the points. I'll include all the points that aren't there. Want to generalize? Yeah. For me, it's both, but more this because I'm more comfortable with long forms now. So I'm gonna try to do more of this. Have you done audit list questions? Because yeah, I did that fun. That's it. He hasn't done response, so yeah, I've been waiting for him. And he hasn't done equity substantive. tax liabilities or something. And
Even the liabilities as stands alone.
yeah. 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 So, can't answer those questions. I just skip them over and mark them for later. For the long form, like I don't know, that's it. But like I think one of the I'm not sure. Last thing, one of the one of the standards is changed. One of the standards is changed. He's teaching unqualified and emphasis, right? There's no more unqualified. It's unmodified and emphasis. You can search it up. It's they changed it. I don't know if I'm reading it wrong, but that's what it said in top now. So like if you need the emphasis paragraph, you just it's still an unmodified opinion. But there's an emphasis paragraph.
Yeah, he doesn't talk.
No, he taught us on
And
qualified, but unqualified. You get me? It's the same with the paragraph. I'm just saying unqualified.
no, yeah, what you're saying is a new standard.
Yeah.
What tell me the standard again? What's the thing?
So instead of a modified opinion with unqualified, there will be unmodified. But I'm not sure because I just got that from copy.
Unqualified is unqualified.
No.
Well, I don't see what you say.
Okay, let's give an example. There's a disclosure for contingent liability. No? What do you need?
Disclose it at the end
No,
of
no, for your audit paragraph. What do you need to do for audit report?
emphasis commander rate.
Yeah, and what is it?
Unqualified, unqualified.
Unqualified, right?
Yeah.
And what is the qualified? It's modified.
No,
No, because it branches out. Does it not branch out? Audit report, modified, modified.
it's the thing.
Yeah. You did the branch.
Yeah,
Okay, that was.
that's how I understand it.
Okay. That's it.
I didn't write unqualified. This is unqualified experience. This is more.
That's what I'm saying. So this is this now. You can search it up. I say 700. Or just read the Kaplan. It's yeah. Search up
This is a review or reporting.
the audit report. It's just the answers in the long forms. It's the same. It's just as unmodified. Never says unconsequences.
Chapter.
No, it's- oh, it is the study things.
Yeah.
What you were supposed to go from? Let's see, there's no unqualified, right?
I think unqualified is just
Different wording for unmodified because. I think.
unqualified is just.
I can't use two clean one. I think it's because I've been teaching too long. All these stuff.
Have you opened his notes?
This one when he's.
When he I opened his notes. It's from 2011. He's been taking the scripture with the unqualified. Something persistent order to say.
Yeah, so I just had to let you know about because he might miss some marks. So it's up to your own risk if you know. With the unmodified one.
Yeah, maybe you should ask him.
Yeah, who asked him? I'm scared.
He's so unqualified.
Scared of work. That's the important part.